get more, though, on today's trade. Chris Conway from the Australian Stock Report joins us live from our Melbourne studio. Chris, good afternoon to you.
Good afternoon, Ingrid.
Busy day for the markets today in terms of macro. In terms of equity markets, though, it's very interesting to see. We're off about another 0.4% today. We seem to just not be able to get back above the levels that we were trading at just a few weeks ago. Chris, what's going on?
Look, I think the market's in a bit of a stalling pattern at the moment, Ingrid. We've had a pickup in volatility. We all know that. We've seen a couple of wild swings in the US, both up and down. And I think, like I said, the market's probably just going to grind sideways for the time being, waiting for the FOMC meeting next week on the 20th and the 21st to wait to see what the Fed does. Probably not likely that they'll move. And then we move into the US election cycle and then, of course, the Fed decision in December. So whilst there has been a pickup on volatility, like I said, I'm very much neutral at the moment. I'm waiting to see where this market will settle. I think opportunities will flow depending whether the market moves higher or lower from there. But not surprised to see it's in a bit of a holding pattern at the moment.
But I guess, what are you expecting then? Because there was a talk that we would move higher or lower, so we'd get some sort of volatility. We're now seeing the lower trend. So with all this macro sort of events happening over the next few months, do you expect that to push us to the upside or downside?
Look, unfortunately, I think we stay in the range. I think we're going to be capped by that 5,400 level that dogged us for the best part of 12 months prior to that break higher in July. But yeah, I think there's so much to digest. You know, we couldn't hold above 5,400 through reporting season, which in hindsight isn't surprising considering the buzzwords around reporting season were, you know, words like disappointing, soft, unfulfilling. So I don't see what the catalysts are. Certainly if Trump becomes US president, whilst I don't think the US presidential cycle has that much impact on markets, you know, it might have a bit of a knee-jerk reaction and keep markets subdued as everyone worries about Trump, what Trump might or might not do. And then, of course, you know, again, it always comes back. All roads, unfortunately, Ingrid, they lead back to what the US Federal Reserve is going to do. Will they, won't they? The second guessing that goes on. I have maintained all along that I think they will go in December. I think they have to. And I've gone back and I've studied what happened last December. And look, there was a lot of volatility in the lead up to the actual decision. But then once the decision dropped last December, you know, markets didn't react all that much. In fact, I think they actually went a little bit higher. Then, of course, in January, we had the China macro issues. And then in February, we had the European credit sort of crunch. So I think everyone's just waiting for this decision to get done and dusted and out of the way and we can get on with business. Because
it was actually a positive reaction, as you said last December, from the Fed move. It was almost like the markets finally saw it as good news that the economy was strong enough to see a rate hike. So do you think that could be possible again? I mean, yes, we're having these sort of somewhat knee-jerk reactions to Fed comments in the opposite ways, but do you expect that when they actually do finally pull the trigger as promised for the past 12 months, that we'll actually see a good reaction from markets?
Yeah, look, I think we will. And look, I raised this comment last time as we went through the same process, seemingly in towards last December. I said, look, I think it's a little bit of Wall Street trying to game the Fed. It's sort of Wall Street saying to the Federal Reserve, well, we really don't want you to do this, and we're going to give you a taste of what we think could happen. But then once the decision's made, Wall Street realises that there's no point but to get on with the game, the business, of buying and selling and trying to make money, and things proceed accordingly. I think that's the same situation we're seeing here. Wall Street's giving the Federal Reserve a taste of, well, you know, we're not really going to like this and we don't really want you to do it. But once it happens, you know, there's been numerous analysts, many before me, say the same thing. It's 25 basis points. It's not 50 or 75 or 100. And the expectation, I think, still is that further increases will be gradual. So I think, like I said, perhaps it's a little bit of Wall Street trying to game the Fed. But once the decision drops, wouldn't be surprised to see everyone go, well, this is the new reality, let's get on with it. Yeah,
it seems that would be a sort of logical way to respond, but we know markets aren't always logical in their response to these sort of things. Let's talk about some stocks we're watching today. Myer, for one, it was initially stronger. It's losing about 2.7% now off the back of its result. Certainly you can draw some parallels, I guess, with a Woolworths type story where the turnaround looks long, but they are making progress, certainly a year into their 5-year plan. What do you take out of today?
I think that is the one solace, Ingrid. I think you've hit the nail right on the head. You know, you compare this to a company like Qantas, who is, you know, well advanced and probably at the other end of its turnaround story. And in the early stages of the Qantas turnaround story, I remember people were calling for Alan Joyce's head and the numbers were terrible and it was a complete disaster. Myer's 12 months into what they're calling a 5-year turnaround plan. There are some signs that things are starting to improve For me, I'm not going to pull any punches on this one. I really hate this stock. It's not a stock I can get excited about. It's not a specialty retail like a JB Hi-Fi or like a Harvey's. And it seems that that's where the money is and that's where the opportunity is with the retail space here in Australia. They're going to spend $600 million trying to turn this ship around. They may very well do it. What's the opportunity cost, though, of holding this stock and a what if, as opposed to buying, say, a JB Hi-Fi, which continues to deliver and has gone and made a pretty good acquisition, I think, in the good guys, and hopefully will deliver even more. So, you know, the potential upside maybe is greater, but I don't trust that spending $600 million is going to do too much to improve Myer's lot in what I think overall is a troubled space.
Yeah, so you just think the model's sort of broken for the department store, but then you look at David Jones versus Myer, and David Jones performed so much better when it comes to same-store sales and like-for-like. So what do you make of that sort of thing? I mean, 3.1% growth for David Jones compared to, I think it was 1.8% for Myer. There is still a big gap there. There's money to be made.
Yeah, look, 1.8% versus 3.1, and I think Myer's forecast was 2.6, so you're spot on with those numbers. But again, that even, to me, highlights even more, why would you choose Myer?
Yeah.
Why would you choose a company that hasn't been able to deliver? Sure, if they get it right, I totally agree with you, Ingrid. The upside potential is greater, but are you willing to take that risk? For me, in that space, the answer would be no, because I do think the model is broken, and I don't particularly think throwing $600 million or perhaps even any amount of money is going to fix the issues in that market. If it was a specialty retailer, or even something like a Premier Investments that's got, you know, really key brands like a Smiggles or a Peter Alexander, then I'd be more inclined. But, you know, some of this is anecdotal for me as well. I don't go to Myer anymore. I heard Ben LeBrun say the same thing this morning, that, you know, whenever he used to go to the city, it would be him and his mum going to the city, and they'd visit Myer or they'd visit DJ's. There's no way in the world I'd go to Myer these days, because there's a specialty store where I can get the product probably cheaper, or I can go online and get it. So, as I said, I know that's only anecdotal, but I think that's symptomatic of the bigger issues that Myer faces.
Okay, let's switch gears then and talk some other stocks that you're interested in right now. And I know CBA has been one you've been long in for a little bit. Obviously some upgrades coming up from Goldman's today as well for CBA. So where do you stand with that now? I mean, obviously valuation is the key here.
Yeah, look, it was very nice to see Goldman come out with a buy rating this morning, and I think an $82 towards $83 price target. Their analysis was similar to ours. They think the sell-off has been overdone. They think CBA is probably best placed to weather the storm that we know the banks will face, and that they're more likely to be able to raise capital organically, which were all points that we raised when we recommended the stock about a week ago now. So it's nice to see it's getting a boost. We were a bit underwater as it, you know, plunged towards the below $70. But the base premise for CBA remains the same. Like I said, we think it's best placed of all of the big four, and it's a similar sort of story to what I was just talking about, Ingrid. You know, maybe NAB and maybe ANZ offer better value on the metrics, but why would you go and buy a business like ANZ that's been wandering around in Southeast Asia for the last 10 years achieving nothing, or a NAB which has been in the UK for a similar period and has just divested itself of a business that it really couldn't manage all that well? CBA doesn't have too many or any of the blots on its copybook. It has strong management, it has excellent cost discipline, the ability to raise capital organically probably more easily than the other big four. Why not pick the best of breed? Yep. Even if you do have to pay a little bit more for it.
Okay, makes sense. In terms of what else you're watching as well, in terms of buying, I know you're looking for some opportunities at the top end. What are you watching in particular?
Yeah, so look, obviously with the bond proxy growth, yield trade unwinding fairly aggressively, no, there's still a mountain of money sloshing around out there. I'm starting to look again at the top end of town. You know, a name like CSL, which has come off quite a lot, 120 back into 100. Still a great business. Bit of a troubled report during reporting season, but still like it. I think the miners, BHP, Rio, have done so well in tidying up their shops, you know, removing excess costs. I think they're in a position to benefit from not only an upside in commodity prices, but the fact that their businesses now run more smoothly. The banks, as we've mentioned, all of them look reasonable, but CBA being the one we'd prefer most. And Macquarie as well just seems to go from strength to strength regardless of what the broader market is doing. So I think some of that money that's coming out of those growth trades, those growth stories, well, it needs to go somewhere. Some of it will probably go into the greenback as interest rates rise. But in terms of a rotation within the Australian equity market, I think some of it can flow back into the top 20, which has underperformed and have been unloved, although not the entire top 20, like I said, the names that I just mentioned.
Okay, we'll leave it there with you, Chris, but lots to watch, of course, at the moment. Thank you.
Thank you, Ingrid.
Chris Conway there joining us from Australian Stock Report.